Bitcoin has fallen below its 50-week moving average. It's had its first weekly close below $100,000, and it even plunged below $90,000 in early Asian hours, erasing all of its gains for 2025. Meanwhile, the Fear and Greed Index has collapsed to its lowest reading since the depths of the 2022 bear market. Yet, beneath the surface of this retail panic, the on-chain fundamentals tell a very different story. Exchange reserves are at a 7-year low, global liquidity is near all-time highs, and key metrics are signaling accumulation, not capitulation. And this striking divergence between market fear and on-chain strength raises a crucial question. Is this just a brutal, leverage-fueled shakeout before the next explosive leg up? Or have we officially entered a crypto bear market? And that's why today we're going to dissect the anatomy of Bitcoin's perplexing price action. We'll define what a bear market really is in both traditional finance and crypto terms. And we'll dive deep into the technical, on-chain, and macro indicators to see if we've actually crossed over that threshold. And finally, we'll look at the key levels, catalysts, and dangerous headwinds on the horizon that could decide Bitcoin's fate in 2026. My name is Nick, and you're watching The Coin Bureau. First up though, I'm not a financial advisor and nothing in this video is financial advice. It's educational content designed to help you understand the forces shaping the crypto market. And if that sounds good, prove it by punching that like button and let's get into it. So, what actually just happened? To understand the current fear, we have to rewind just 6 weeks back. On October 6th, Bitcoin was printing a fresh all-time high of over $126,000 and the market was euphoric. But that euphoria was short-lived. The turning point came on October 10th when a flash crash triggered by US-China trade tensions sparked one of the largest liquidation events in crypto history, wiping out over $19 billion in leveraged positions. Then, on November 4th, Bitcoin broke below the key psychological level of $100,000, the first time since June. And the selling accelerated through mid-November, culminating in a plunge below $90,000 during early Asian trading hours on Tuesday, November 18th. At its low of $89,420, Bitcoin was down a staggering 29% from its peak.
So, what gives?
Well, this wasn't a single event, but a perfect storm of negative catalysts. First, the Federal Reserve slammed the brakes on market optimism. Just a month ago, traders were pricing in a 95% chance of a December interest rate cut. But after a series of hawkish comments from Fed officials, those odds collapsed to less than 50%, sending a shockwave through risk assets. Second, a US government shutdown created a liquidity vacuum, with market watchers noting it was one of the driest periods for fiscal liquidity in years. And third, the institutional buyers who fueled the rally suddenly turned into sellers. Spot Bitcoin ETFs, which had absorbed billions, saw a net outflow of nearly $2.8 billion in November. Put all of it together and you get a market purged not by a crisis of faith, but by a crisis of leverage. Over $1 billion in liquidations on November 4th, another $1.1 billion on the 14th, and another $1 billion on the 18th. This was a mechanical, forced deleveraging event. But with a 29% drop from the highs, does that mean we're now in a bear market? Well, the answer is more complicated than you might think. In traditional finance, the definition is quite clear. A bear market is widely considered to be a drop of 20% or more from a recent peak in a major index like the S&P 500. The 20% figure is somewhat arbitrary, but it serves as a psychological line in the sand, signaling a significant shift in investor sentiment and the growing risk of a recession. Since World War II, the average stock market bear has seen a decline of about 30%, and has lasted around 13 months. But here's the thing, a 20% drop in crypto is just a Tuesday. The volatility is so immense that applying the same yardstick is almost meaningless. In crypto, the key word in the definition is prolonged. A 20% dip over a week isn't a bear market, it's a correction. A true bear market requires a sustained downtrend lasting at least a few months and confirmed by a breakdown in key market structures. So where does this leave us? By Wall Street's definition, yes, Bitcoin is technically in a bear market. but by crypto's more battle-hardened standards, it's in a severe mid-cycle correction that is knocking on the door of a bear market. And to see if that door is about to swing wide open, we need to look at the technicals. And the most glaring warning sign is the 50-week exponential moving average, or EMA. For nearly 2 years, this line, currently sitting around $101,000, has acted as the backbone of the bull market. Every dip towards it was bought up. And last week, we closed below it for the first time, a major structural breakdown. And then there's the dreaded death cross. On November 16th, Bitcoin's 50-day moving average crossed below its 200-day moving average, a classic bearish signal. But here's where context is king. This is the fourth death cross of this bull cycle, and in the previous 3 instances, in September 2023, August 2024, and April 2025, the death cross actually marked the late stages of the correction, right near the local bottom. Coincidence? I think not. And it seems the market has been using this widely feared signal as a liquidity grabbing event before reversing higher. Adding to this contrarian view is the Relative Strength Index, or RSI, and it's currently sitting at 29, firmly in oversold territory. Historically, readings this low have preceded significant relief bounces. So the technicals are sending conflicting signals, a major structural breakdown on the weekly chart, but potentially bottoming signals on the daily. Now, technicals show us the what, but to understand the why, we need to go on-chain. And if you're looking to trade this volatility or perhaps buy this dip, then you have to check out the Coin Bureau Deals page. That's where you will find exchange sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges around. Just hit the link in the description or scan this QR code, which will take you right to the deals page. There you'll see all of our offers across a range of exchange partners. Simply click one of these sign up now buttons and these should take you right to the deal. Now, these deals won't be around forever, so take advantage of them while you still can. Again, by hitting the link in the description or scanning the QR code. Back to the video. Now, if you looked at sentiment, you'd be running for the hills. The Crypto Fear and Greed Index recently plunged to a reading of 10, deep in extreme fear territory. And this is the lowest reading since the FTX collapse in 2022, signaling absolute terror among retail investors. But as Warren Buffett famously said, the time to be greedy is when others are fearful. And when we look at the on-chain data, a powerful bullish counter-narrative emerges. Let's start with exchange reserves. Despite the price crash, the amount of Bitcoin held on exchanges has continued to plummet, hitting a 7-year low of just 2.38 million Bitcoin. And this is not what happens at the start of a bear market. Bear markets begin when holders rush to deposit their coins onto exchanges so they can sell them. What we're seeing is the opposite, a relentless draining of available supply, setting the stage for a potential supply shock. Next, we have the MVRV ratio, which compares Bitcoin's market value to its realized value. Now, think of it as a gauge of the market's overall profitability. Historically, cycle tops occur when the MVRV is above 3, indicating widespread euphoria. Bear market bottoms happen when it drops below 1, signaling mass capitulation. Right now, the MVRV is sitting at about 1.8, and this isn't a euphoric top or a capitulation bottom. This is a reading consistent with a mid-cycle accumulation phase. But what about all of those OGs? Are the long-term holders finally cashing out? Well, yes and no. On-chain data shows long-term holders have distributed around 400,000 Bitcoin over the past month, and that sounds like a lot, but it's crucial to put it into perspective. This level of distribution is nowhere near the scale we saw at previous cycle tops. In fact, over 70% of Bitcoin's total supply is still held by these long-term high-conviction investors. So we have a paradox. Retail sentiment is in the gutter, but the on-chain fundamentals look like a coiled spring. The tiebreaker, as always, is the macro environment. And here too, the data argues against a prolonged bear market. First, let's look at the US dollar index, or the DXY. Historically, Bitcoin has had a strong inverse correlation with the dollar. A strong dollar sucks liquidity from global markets, hurting risk assets like crypto. A weak dollar does the opposite. And right now, the DXY is significantly weak, trading well below its 365-day moving average. And this is a tailwind for Bitcoin, not a headwind. And then there's the big one. Global liquidity, often measured by the M2 money supply. And Bitcoin's price is notoriously sensitive to global liquidity, which recently hit a record high. There is typically a lag of about 3 months between liquidity injections and their impact on asset prices. And this suggests that the fuel for the next rally is already in the tank. We're just waiting for the spark. And that spark could come very soon. Over the next 2 months, we have a series of massive potential catalysts. The single most important event is the Federal Reserve's FOMC meeting on December 9th and 10th. The market is currently pricing in a coin toss on whether they will cut rates again or hold them steady. A surprise cut could reignite the market, while a hawkish hold could lead to another leg down. We also have a Supreme Court decision on tariffs expected in December or January, which could inject serious volatility. And finally, we have classic year-end market dynamics. We could see further selling pressure in late December due to tax loss harvesting. But this often sets the stage for a January effect, where fresh capital is deployed at the start of the new year, sparking a rebound. Of course, the risks are just as real. A hawkish Fed is the #1 threat. And we also have lingering concerns about miner capitulation, with firms like Bitfarms pivoting away from mining due to financial stress. And while the Mt. Gox repayment deadline has been pushed to October 2026, any large movements from their wallets still have the potential to spook the market. So let's bring all of this together. Are we in a bear market? By the traditional 20% definition and the technical break of the 50-week moving average, the bearish case is strong. These are undeniable warning signs that should not be ignored. However, the on-chain data paints a completely different picture, one of accumulation, extreme supply scarcity, and a profound lack of the euphoria that defines a true cycle top. This does not look like your 2018 or 2022 bear market. This looks more like a severe mid-cycle correction amplified by a massive leverage flashout. The battle for the next few months will be fought between the bearish technicals and the bullish on-chain fundamentals, with the Fed's December decision likely being the deciding factor. So, what are the key levels to watch? On the downside, the zone between 88,000 and 94,000 is now critical support. This area represents the cost basis for many institutional buyers. A decisive break below this could open the door to a deeper retest of the low 80,000s, or even the April lows around $76,000. To the upside, the bull's first job is to reclaim the $100,000 to $101,000 region. Getting back above that 50-week EMA is the essential first step to restoring the bull market structure. And while the short-term picture looks messy, it's worth remembering where the smart money thinks we're headed. JP Morgan has a 2026 price target near $170,000. Bernstein is forecasting $200,000. And Standard Chartered is calling for a staggering $300,000 in 2026. And this suggests that even if we see more short-term pain, the largest players in finance are betting on a much, much higher future. The dream of a bullish end to this cycle isn't dead. It's just been severely tested. But what do you think? Is this the final brutal shakeout before a new all-time high? Or is the bear officially here to stay? Let us know your take in the comments down below. And if you want a deeper dive into how institutional ETF flows are fundamentally changing this market, then check out our video on that right over here. Thank you all so much for watching, and I'll see you again very soon. This is Nick, signing off.